today since the classroom we did this morning on gold. So it's all been selling today. So when we understand that and we look at how much selling is coming in, we look at if we look at the indicators and we look at the volume profile, for example, if you see just how much volume was in this balance area, and you can look at that and say, look at the volume in those areas, and then they ran that liquidity off the table. They got so many sellers trapped into that area, and they all, look at the size of the volume spike as soon as they ran that stop. A huge surge of volume because everybody was looking at it saying, wow, get me away from this, get me away from this, something's happening. Straight into your selling, guys, straight into your selling, because you're doing what? You're working offers against a lean. So it should be your selling. There's got to be a bid up there. There's got to be a bid up there that you can lean against. And you're going to start offering into that lean. And obviously the takeaway from that was sensational. And then they did it again. Fast, furious, trapped all the sellers again. They were all selling into this phase. Trapped the sellers, ran the stops a second time. And then that sell-off was sensational. We went from 86s to a low price of 70. It's a $1,600 sell-off. $1,600 sell-off, guys. So when you see that, you can start to understand it. Now you might be saying, well, why was it a good sell? Why was it that good a short trade? Well, of course, it's all to do with the value, and the most important value we have is real yields. When we look at real yields, is there anybody that thinks that gold's been a buy trade at any stage, really? Is there anybody that thinks gold is a buy trade at any stage except for scalpy bottom edges? There's certainly no buy cross spreads, is there? You wouldn't have ever have crossed a spread to buy gold, would you? Here? Yes? No? There is absolutely no chance you'd cross a spread to buy this. So in other words, it's just a short, isn't it? It's just a short, unless you're willing to fade a bottom edge, because there is no bullishness about this line. There is no bullishness about it. It just stops being bearish. So therefore, when you're selling this, all you're doing is selling this down into those areas. You're selling this down into those brackets, and you're starting to draw some brackets into this so you can start doing measures and various other things. You can see a beautiful bracket forms here, which is pretty crazy because it was a halfback sell, wasn't it? It was a halfback from the bottom edge to the top edge. This was a halfback almost perfectly. Right there, there's the halfback trade right there, and that added to the sell-off. And that gave you the prop stops level just here, which was your first area of targets, and your main target was down here. And that never hit. The main target never hit into that main target price. So obviously this is a great starting point for your gold analysis. So the sell at the top edge is absolute no-brainer, right? No-brainer sell. The timing couldn't have got any better. What happens at 1400 hours? We get the COMEX, we get the NYMEX volume starting to pour into the markets, the commodity markets. And we start to recognize the opportunity to work the short trade against the NYMEX and COMEX market opens. And we start to see the opportunity to pick up the volume into those highs. And the sell-off is beautiful. I mean, look at the other shape of the markets. There's not even a decision to make in this. The J's were dropping as well as the euro was dropping, as well as the real yield was rising. And because of that, that's a great storyline for short gold, isn't it? Great storyline. They just make it awkward. They make it feel like it's dead uncomfortable, don't they? How many of you guys felt uncomfortable by the speed of market move to the upside? Probably most of you, right? Probably most of you. You probably saw that spike higher and you thought, I can't sell that. You're squirming around trying to find a reason why it just spiked higher. You're confused. It's a little bit, what's going on? Who thought that as soon as they saw the gold spiking like that? Who was all questioning why? Because that's what happens, right? The best trades are always the ones that they cause you to question. They cause you a lot of chaos. They cause you as much annoyance and worry as they possibly can get away with to try and get you to stop selling it. To try and get you to stop selling it so that they sell it. If you're selling it into that big area where we were selling into that big area, there's a lot of people that have to get away from that trade. I'm glad I wasn't in a heavy short gold trade. We're not big gold traders. But we still have a problem trying to get away. If we get too big into that trade itself, then everybody's in a troublesome. They're all trying to get out of that very, very narrow funnel, and that's what causes the spike. Your job is to lean against the spike, which means you're not selling it on the way up. You're selling it on the way back down. You're crossing and taking whatever liquidity is available on the book. You're taking the liquidity. You're not adding. You're using. You are a user. And you're taking that liquidity for a ride south. You're taking that liquidity for a ride south, and then you're starting to see the diverging storylines in here, starting to think about the possibility of a buy at the bottom edges. It's just not crossing the spread, though. You're not crossing the spread in this. If you're going to buy this gold, it's got to be a buy on down-ticking bottom edges, using things like the volume count to 1, 2, 3s. So if we use the volume count into the 1, 2, 3s, does anybody see any possible opportunities? Yes. Because if we look at the time segmented volume, it's quite obvious where 1 is, right? You all agree where 1 is, yeah? You all agree that 1 is very obvious? 1 must be the low of that phase there. So that's the one you can't sell. That's the one you cannot buy. That is the one you can't buy. 2 is obviously right here, isn't it? There is 2. That's one that you can buy, but it's obviously risky. So we obviously can mark that level and say, right, there's 2, and there's a new one right there. 3, potentially right there, 3. Would it have been better if it was slightly lower? Of course it would have been. But that would have been your 3 point right there. So you could say, well, I've got as big a chance now as any of getting a little bit of upside. Now, as I said, you would not be crossing gold spreads, not with that amount of bears in play. So if you're not going to cross the spreads, when the price trades up into the top edges, you should be booking, guys, because if you're not crossing the top spread, nor will anybody else. So when you come up into those bracket high levels, you've got to be taking a bit of cash, guys. You've got to be taking a bit of cash because you're not crossing. It's not good enough to cross. Until that develops out a little bit of time and effort, you should not be crossing this gold to pay up. You're buying bottom edges, but you're not crossing. Not a chance, guys. We'll be getting started in classroom in a couple of minutes.